All right, so today we're going to be going over basic investing strategies and more on financial markets. First, we're going to cover the basic financial statements and ratios, which we went over last meeting. Then we'll go over investing strategies and long-term investing, followed by financial markets knowledge, such as shorting, squeezes, and what they are. And then finally, the differentiation between long stocks and short stocks. All right, so we're going to review quantitative analysis right now. Fundamental analysis. So this is a tool that you'll use to determine the intrinsic or actual value of a stock. And there's two ways to do this. First, quantitative analysis, that being financial statements and ratios, or qualitative measures such as the SWOT tactic or Porter's five forces, which we talked about last meeting. And now how to read charts. So for example, on the left, you see a increasing bullish candlestick, and the thicker part is the difference between the open of the market and the close of the market, while the thin lines on the edges, on the bottom being the lowest price that the stock went to, and then at the top being the highest price. And then with the decreasing or bearish candlestick, it's the same thing but opposite. Or actually, it's so at the top you get the open at the top of the thick part, and at the bottom you get the close of the market and the price it was at. And then with a thin line, you get the low at the bottom and the high at the top. Financial statements. These describe the financial situation of a company, and they can include the profit and loss or income statement, the balance sheet, and the cash flow statement, which we showed examples of in the last meeting. And some more on financial ratios. So ROE, or return on equity, which is net income divided by shareholder equity. ROI, or return on investment, which is the final price minus the cost divided by the cost. PE ratio, which is a very common one, which is price to earnings ratio, which is the price of the stock divided by earnings per share. And then PEG ratio, that's price to earnings to growth ratio. So you take the PE ratio and then divide that by the growth rate. And finally, EPS ratio, which is income per share of common stock. To get this, you'll take the net income and divide it by the number of common shares.
All right, now that we had a bit of a recap of the past lessons, now we'll go over some different types of investing strategies. The first and most commonly mentioned investing strategies you'll hear overall are growth versus value investing. Growth stocks, or growth investing, are stocks that you invest in that are speculated to skyrocket in revenue and size in the future, or that you have done research on and fully expect to see massive growth in the future. So companies like these would include tech, would include rising fields like AI, genomics, cryptocurrency, and even something like Tesla. And these are just seen as really great opportunities by growth investors. And a lot of growth investors will bet a lot of their portfolio into them in hopes that they'll have huge rewards in the future. On the other spectrum, on the other side of the spectrum, rather, we have value stocks and value investing. So value investing means that you invest in stocks that are priced lower than their fundamentals suggest. So you look for stocks that are priced in the market at lower than their intrinsic value, which would be their earnings. And you determine this obviously by looking at earnings, by looking at ratios, by financial statements, and by our qualitative frameworks. So value stocks are just seen as bargains by value investors, and generally they'll hold them until they reach their intrinsic value, and if they have more faith, they'll hold them a little past that. But generally, value investing is a lot more for the long term. So a bit more on growth investing. Growth investing focuses on growth stocks, and these are ones that will, as we said, have expected growth much higher than the average market. Their relative price is also much higher than their book value or earnings, so their PE ratios are generally going to be really high. These companies also generally don't pay out dividends, like Tesla doesn't pay out dividends because they want to reinvest all of the extra cash that they have into developing new and better products. So since investors don't really get dividends, there's a risky investment and they can only capitalize on the sales of the stock later on. So you really have to be invested and done your research well on a growth stock so you know when to pay out or when to get out. And these companies generally also have like unique product lines and unique patterns and things like that, and unique patented products that make them a lot of money and that help them grow really quickly. They also usually have like Tesla or like Amazon or any of these tech companies. They also usually have loyal customers. They have huge market share and growing market share. More importantly, so many small cap stocks are growth stocks, and not many large ones. Many large cap stocks fall into the blue chip category, so it'll be long, stable investment. And of course, as we mentioned, there's much higher risk because there's higher potential for loss as these companies grow much faster. So there's a few key factors that you want to look at when you invest in growth stocks, and that'll just be fast earnings growth, high forward earnings growth, and you can look at profit margins depending on how they are. But a lot of times, for new, quickly growing growth stocks, the companies will generally have negative profit as they'll be expending more than they're earning. You also want to look at return on equity and make sure that it's fairly high, as well as stock performance, and make sure that a good target to have is 15% yearly growth for growth stock, or even higher in the current market, which has been supercharged. So a bit more on value investing. Value investing requires purchasing stocks that you've determined are undervalued based on your own independent analysis. So this would just be looking at price to book, price to earnings, or free cash flow. And price to book or book value measures the value of a company's assets to the stock prices, as we've talked about them. We also discussed PE ratio and free cash flow in past meetings. Basically, value investing is like buying stocks on sale and then selling them when they return to normal price. And stocks can generally become undervalued due to bad publicity or some other event that either reduces the stock price or there's just not enough attention towards the company. So it's much lower than its market value should be. Value investing can apply to both new companies and more successful companies, but you'll have a lot better returns, more success with small companies, as not many people have it on their radar and not many people are pushing the price up. So this strategy can be risky when you're buying when the investors and the market have a false view of the company and you're kind of betting that public perception will change for the better. But it is sometimes a good mentality to have, as you can find companies that really are good and really are against what the general public perceives. So you're kind of going against that herd mentality. Another type of investing is momentum investing. This is just where investors try to capitalize on trends in the market. So this will be if a stock is going up, momentum investors will catch on the momentum of it and follow it up, follow it down with shorting and other financial instruments. So momentum investors really look for that volatility, but few investing firms use momentum investing because they believe it's too speculative and pretty unpredictable compared to using fundamental analysis. This is a quick chart of momentum investing, and I mean, as we can see, this stock is Google, as you can see, but generally, as the stock is flying upwards, a momentum investor will buy on and just continue to hold it as it goes up. One of the last types of investing is dividend investing. And this, simply put, is when you reinvest whatever dividends the company pays to you back into the stock. So you continue growing your share of the company. And dividend investors invest in reliable companies because that way they can get that stable income through the dividends. And obviously, dividend investors, they make gains through both dividends and the stock's rising in value. Next, we'll go over swing trading. So swing trading is when traders attempt to time the market and other short-term movements using technical analysis, fundamental analysis, or just watching the news for events that might be a catalyst for the stock. And swing traders, they'll hold them for any kinds of range. Some people might hold for a couple of days or a couple of weeks. Others hold for months at a time for the stock to do their desired price movement. Swing traders also expose themselves to high amounts of risk and volatility through their trading. So here's an example of a really famous investor, and he's a value investor, Warren Buffett. So Warren Buffett, his key traits are that he has discipline, patience, experience, and he generally holds stocks for decades at a time. And I mean, he started his company and his investing business with $100,000, and his company's now worth 600 billion. So obviously, that's a huge return. So, what strategy should I use? Obviously, you can choose what kind of investing strategy you want, and you can also mold the different strategies together. So, let's say maybe you want to become a bit more aggressive of an investor. You can put more of your portfolio towards growth investing and have a little bit for value and dividend just for that extra stability. But maybe you want to go full stable. You don't want to have any risk. You want to expose yourself to as little risk as possible. You might become a value investor. You might become a dividend investor. And obviously, you'd want to employ diversification through this because a balanced portfolio can contain many different types of investing strategies and styles to minimize risk for you. So, just to quickly go over the concepts we covered, growth investing is when you invest in speculative stocks or speculative companies hoping for future growth and explosion. Momentum is catching on to market trends and hoping that they'll continue. Do your own research, obviously. Then we have swing trading, which means you time the market and take advantage of short to medium term moves. We next have value investing, which is just going based on fundamentals, finding stocks that are cheaper than their intrinsic value or cheaper than their fair value and getting a good deal. Dividend investing is just using steady income from company payouts, and generally this requires huge amounts of capital invested in a ton of dividend stocks for you to make good return on your investment. And lastly, diversification. We've covered this many times, but you don't need to stick to one form of investing or one strategy. You can always diversify. You can use different types of strategies in your portfolio.
All right, so now let's go over some stock vocabulary, such as long versus short and trading versus investing. So what's the difference between these? Okay, let's start with the difference between long versus short positions. So long positions are just the standard. When we say we're buying an asset, we call it a long position because you're hoping that it goes up in value. For example, a long position could be buying commodities, stocks, or real estate, hoping that the position goes up in value. So a long position means that you're betting that the value of your asset will go up. On the other hand, a short position involves short selling an asset, hoping that it goes down in value. So when you short a stock, you call it a short position, and you're betting that the stock will go down in value. So how does short selling work? So when an investor wants to short a stock, they can request to borrow some shares from their brokerage for a set price. Whenever the investor wants, they can purchase the same number of shares back to pay off the shares that they borrowed. And they get to keep the difference between the price they borrowed it at and the price they give the shares back at. And that's how you can make money shorting it when the price goes down after you buy it. So let's say you borrow 10 shares of a stock at $100. So the total cost of you borrowing the stock is $1,000. So now you owe $1,000 to your brokerage. But let's say the stock falls to $90 per share. And since you only owe 10 shares, you get to pay back those 10 shares at $90 per share or $900. And since you initially borrowed $1,000 worth of stock and you only have to give back $900 worth of stock, you get to keep the $100 in between, leading to a $100 profit overall or 10% on the investment. So what are the risks of long versus short positions? Long positions and short positions, their risks are opposites. On long positions, your max loss is the entire investment if the stock falls to zero. However, the max gain is usually infinite because there is no cap on how high a stock can go. Stocks can grow to the moon. For example, decades ago, Apple was almost worthless as a company, but today it's worth over $2 trillion. But short positions are the opposite. The max loss is infinite because a stock can keep going up, and the higher it goes, the more you owe your brokerage for borrowing those shares. So if the stock goes up, you will have to pay that excess. However, the max gain is just the entire investment. So the max gain you can make on a short position is doubling the position. Because when a stock crashes to zero, you don't have to pay anything back and you get to keep all of the gains that you borrowed. However, it's very unlikely that a stock will crash. Okay, so now let's go over trading versus investing. So traders can take advantage of short-term market movements and trends to make quick gains. It's discouraged for newbies. Some types of trading are day trading and swing trading, which we've gone over before. On the other hand, there's investing. So investors buy and hold stocks with the intention of gradually building wealth over a period of time. People invest to save for retirement. It's often viewed as much safer than trading, and it's often viewed as much more methodical than trading. And the timeline for investing is much longer, such as value investing, dividend investing, growth investing. It's usually much more based on the fundamentals of a stock rather than short-term movements. So what are the benefits of trading or investing? So first, let's go over the benefits of investing. Investments are usually held for a period of years or even several decades. Investors receive perks such as interest, dividend payments, and even stock splits, which is when a stock adds more shares, and that usually leads to the stock going up in value. So even though the markets will fluctuate, investors hope to ride out the downtrends with the expectation that losses will eventually recover. So if a stock dips temporarily, this would be very bad news for a trader. But since investors usually hold for a very long time, they don't really have to worry about it since they believe that their losses will eventually recover in the long term. So investing is very useful when saving for retirement over decades because you can hold stocks for decades at a time and they'll slowly grow in value. And usually by the time you retire, your investments will have grown to such a value that you have more than enough money to retire. However, the goal of trading is to generate returns that outperform buy and hold investing in the short term. Traders aim to buy stocks at a low price, hold them for a very short period of time, and then sell them at a higher price. So the key benefit of trading is compounding, where several small gains pile up over time. So if you make 10% every month, by the end of the year, your total portfolio value will be tripled. However, trading is very dangerous and it's also very difficult, so the chances of you making 10% a month is very low. All right, thank you for coming to our presentation.